Hey guys, so this is the third episode in the series. If you've not listened to the first two episodes, make sure you go back in time to check those out first so that you have a full understanding of what it is we're talking about today. What about you in terms of break-even point, things like that? What are some of the things that you ought to use a break-even point in order to be able to use in terms of management and sort of goal setting and things like that? So on to today's episode. We give that number to our clients every month. Here's what your break-even point is. So they can have that context of, I want to make $30,000. My break-even point's $45,000. I got to be producing 75. Right now, my average is 55. I got a lot of work to do. They're not going to be surprised when they don't have $30,000 at the end of the month. They're going to know what that is. So what about you in terms of break-even point, things like that? What are some of the things that you ought to use a break-even point in order to be able to use in terms of management and sort of goal setting and things like that?
Yeah, so I think it's probably important that we talk about the things that go into that break-even point. It is a few additions to the calculator and a subtraction. So when we look at a break-even point, like what was all of the costs involved from your P&L for the month, right? So what was your total cost to operate? Then we're going to add back those owner's discretionary expenses, like the owner's wages. We're going to add that back. We're going to add back depreciation and amortization because those are paper entries that go on. And then we're also going to subtract out and say, how much were your principal payments on your debt to get to your break-even point? Those break-even points, I find that to be most useful in determining how much cash you need to keep in practice. If I'm looking at a client that has a break-even point of $100,000 and they have $700,000 in their business checking account, I'd say you've probably got a little bit too much cash in your practice. It's not working for you. So what you do with that cash, there's a lot of things. Call your financial advisor and talk to them about that. If we've got a client that has a $100,000 break-even point and their cash in the bank is $50,000, it's like, look, dude, like we probably should slow down this owner's withdrawals. We probably should slow down all these different things. We need to get that cash to a point where you can sleep well at night, that you've got the liquidity to be able to operate. And when we look at that ratio, so like your break-even point to the cash in the bank, it's very similar to what we were talking about with the balance sheet and looking at the current assets divided by current liabilities. Like it's not the same exact number, but it's the same concept. How many weeks worth of cash do you have to operate? So if the spigot of income gets turned off today, how long can you operate? Can you operate for a month? Can you operate for a week? Can you operate for 6 months, 8 months, 10 months, 12 months? So those are the things that I like to talk to practice owners about. And we get the question all the time, like how much cash do we keep in the practice checking account? And a lot of that has to do with the comfort level of the practice owner. So there are some practice owners that want to empty the checking account out every month and take all that money home. There's some practice owners that say, hey, I really want to make sure that I keep $100,000 or $150,000 or $50,000. That number is different. Like that level of cash and comfort is different for everybody. The thing that I like about the break-even point is it takes the emotion out of it. And it just says, here's how much it costs to operate your practice, period. Now we can figure out what you want to keep cash-wise on hand with that.
Yeah, completely agree. And I think that's probably one of the biggest comfort levels you can get as a business owner is to reach that cash goal. Because once you've hit that point, you can just optimize and really work towards those goals. I really like using the break-even point as a goal set standard too, because let's say that I have a personal income goal of $40,000 a month. Our average break-even point is $50,000 a month. Again, we give our break-even point to our clients each month, but we also give a rolling quarterly average as well as we give a year-to-date average so that people can understand really how's that break-even point trending? Where's my average? What is the number that it looks like? So you can have a bit of normalization to that number as well. So you have a little bit of a plus or minus on there. So let's say a $50,000 break-even point is the number that you've been averaging, or a fairly consistent number, because obviously things come up and down and things will happen that, create one-time expenses. But by knowing that break-even point by heart, knowing it's $50,000, if I want to make $40,000, then I know I got to be at $90,000 a month in collections. I know that has to happen. And if I know that we're going to be open 18 days out of the month, the quick math is, I think that's $5,000 a day. It's 90,000 divided by 18, $5,000 a day. Yes, almost a minor in math still works. So $5,000 a day is what you got to get to in order to be able to hit $90,000 in collections. And all of a sudden, I've created a quantitative number that we can use to quantify what it is we need to be bringing in order to be able to set some type of a standard. If I know right now we're averaging $4,200 a day, I know that number has to change. I have to get an extra $100 a day in there. If I had that $5,000 a day number in my head, what I tell people to do is break it into two segments, break that into hygiene and break that into doctor collections. Hygiene is usually a little bit easier for people to calculate. It seems to be pretty standard. Like over time, there's a normalization of hygiene revenue, it seems like, because there's just not a whole lot of extra services that get added into hygiene. You have a prophy, you have x-rays, and you have fluoride. Maybe you have some perio treatment or something like that if your practice is doing that. But overall, that revenue is fairly consistent from a hygiene perspective. And so let's say that you got 2 people there every day doing hygiene, and you know that your hygiene is going to be somewhere around $1,800 a day in collections coming from your hygiene department. Every practice is going to be a little bit different about what they do or don't do in this terms of those numbers. That gives you $1,800 a day, $900 a hygienist goal, and it gives you a $3,200 doctor production in a day. And so that allows you to then say, okay, if my goal is $3,200 in a day, what does that look like in terms of what I am commonly doing in terms of production? Is that 2 crowns a day plus some exams and plus other things? What is that number to you as a dentist, as a practice owner? Is that 1 new ortho case a day? What is that number? And that gives you a lot of power to set some type of a goal. Once you have those goals set, you can then bring your team in. Again, this is the reason to circle back to the part about having good staff is you want to have a team to be able to help you reach those different production goals. And that's where you start the training. You can start working on those different things. And I think it's a good starting point for allowing you to be able to come up with what you need to do in terms of what the production does. And again, that's just one use of the break-even point. If I was a business owner, I would always know my break-even point. I am a business owner. I do know my break-even point. But for all my clients, I urge you to understand your break-even point because there's a lot of power in that number from a bunch of different aspects. I wish the break-even point was just a standard financial statement number. To me, it's probably the most powerful number that you get from your financial statements, but it's not on your financial statement. You have to calculate. You have to know what you're looking for in order to be able to look for it. So me, yeah, the break-even point's like a magic number almost that everyone should know. So anyway, so that's break-even point. Is there anything else on the P&L that you want to talk about? We went pretty in-depth on the P&L.
Yeah, no, I like to look for trends. I like to see if things look out of whack. I like to look at measures of percentages over time. Those are going to help tell the story as your practice grows or as your practice shrinks. Maybe one of those things that you grew too fast, you had too much stuff going on, too much expenses. You hired a couple of associates and you're like, man, I need to go back to just being a single practice owner. Like those percentages will help you understand what the story is and evens things out over time. So those are the big things that I'm looking at for sure.
Same here. So let's move on to the last one. Joseph and I talked about this financial statement before the call, and I said you'd probably be surprised by my answer to this one. The last one's the statement of cash flow. And in terms of the statement of cash flow, what is it that you're looking for when you're analyzing a statement of cash flow?
So the statement of cash flows is the beginning number of the statement of cash flows is what was your cash in the bank minus your credit cards at the beginning of the month. The bottom number on the cash flows, what is that number at the end of the month? The statement of cash flows tells you how you got from your beginning balance to your ending balance. So there are a couple of different things that go into how we got from A to B. The simplest, easiest way, and I'm not going to use the accounting technical term, is number one is what was the profit, right? What was the net profit of business? And then we're going to add back non-cash expenses, depreciation, amortization, add those things back. And then we're going to subtract out, did we buy any assets this month? Cash assets. And then we're going to also subtract out, we're going to say, how much did we pay in principal payments in our debt? So how did we get in cash in the bank from X to Y? So when I'm looking at the statement of cash flows, and then how much do we take out in owner's distributions? That's another pretty key component. When I'm looking at the statement of cash flows, first thing I'm looking for is, did the cash go up or down over the period? And then the next question is why? As I'm looking at that, and then I also look at that ending cash balance, I'm looking at that break-even point and seeing whether or not we're in good shape or not. If the ending cash balance is still 7 times your break-even point, it doesn't matter that cash went down $10,000, $5,000, whatever it is. Like that's not a statement of alarm. I also am looking at the cash flow statement because we have a lot of owners that are saying, hey, look, I'm not paying myself a salary. I'm a Schedule C filer. Like, how much can I afford to pay myself? And that's one of the first places that I go and direct them at is I say, let's look at your cash flow statement. Let's see how much cash was produced in the practice last month versus how much came out, right? So let's look at that. So I like to look at whether the cash increased or decreased and why. And then I try to figure out how much was taken out in owner's distributions and was it enough or too much or that kind of thing in order to figure out like where the cash balance is compared to the break-even point. So those are some of the things that I'm looking for. If cash went down by $10,000, but that's because we paid off our line of credit, like that's not a bad thing. If cash went up $100,000 and it's because we took out a 50% interest hard lender line, like that's a bad thing. So like, how did we get from cash in the bank at the beginning to the end and what makes up all of those different pieces? Like obviously loans are a big part of practice ownership, but if you're taking out a loan in that kind of a way where you're just desperate for cash and you got to take it out at a really high interest rate, then that's not something to celebrate because your cash went up because you took out a cash advance on your credit card. That's not a good thing. So cash at the beginning, cash at the end, and then how do we get there? What are those bigger key components? Like hopefully you ran a net profit for the month. Hopefully you took out some sort of an owner's distribution. You probably had some sort of a payment on your line of credit. and you may or may not have bought a new asset inside the crack. Those are like the high level things that I'm looking at, just to make sure that it makes sense over time. And then comparing that back to your break even point and why it's so important, comparing that back to your break even point and seeing what the cash looks like. What about for you? What are you looking for in a statement of cash flows?
The first thing that I'll look at in the cash flow again is if it's internally prepared by our firm, then I'm actually looking at it. If it's externally prepared, I usually just throw it in the trash because I know it's probably not going to be prepared well. Statement of cash flows is one of the most complicated financial statements to create for some reason. I think that the reason is because most bookkeepers and most CPAs do not have any need for a statement of cash flow whatsoever when they're preparing a tax return. You do not need one for a tax return at all. And so I think that most people just ignore it. They basically just hit the print button on their financial statements and statement of cash flow pops out and they give it to the people and they go along with it. I think that's what the standard is for most statement of cash flows. If it's internally prepared, I know it'll be done well with the software that we use, the way we have it set up. It's going to give us what we need. Like you said, the way the statement of cash flow is set up is a three-prong approach. It has grouped beginning balance, plus or minus operating expenses, plus or minus investing activities, plus or minus financing activities. And the end is what your cash balance is going to be. And there's going to be a delta between the beginning and the end to see where that money went to. If you don't normalize that, that number is going to be worthless. Like it's not going to make any difference at all because you may as well have just looked at your bank statement because your bank statement has at the beginning of the month how much cash was in there, has a deposits, it has a expense, and it has an ending balance. The bank statement says the same exact thing, but in the statement of cash flow, it groups things into logical ways to be able to tell what's going on. Yes, the times when I would look at the statement of cash flow or whenever I'm looking at like a year-end analysis, if I have clients saying, what happened to my cash? The statement of cash flow is where you typically tell them where the cash went to. You do a rolling number of showing them, okay, beginning of the year, you had this much cash, you paid this much in loans back, you took out this much in extra, whatever, in distributions. Here's what you paid yourself and here's where your cash went to. That's the rolling number. That's the standard for like small CPA firms or when you have small business clients. You have to do that almost every year for most clients whenever you're a small CPA firm. For us, we don't do that because we do that every month. We do it in a customized way to show people three things. Number one is cash profit. Number two is what your cash profit versus your tax profit is. Cash profit is not what ends up on your statement of cash flow, but we use that number to help us calculate what cash profit is. We have to do those add backs just like how we did with the normalization of the income statement. You have to normalize that to be able to say what happened to your money. I skipped over the third one, which is what is your tax profit versus your cash profit, because those two numbers are very different. And people get those really confused. We talked about on the financial statements, like what's at the bottom doesn't make a whole lot of difference because it could be that the owner paid themselves something or another. Cash profit's the same thing. Your cash profit is not going to be anywhere on your financial statements. You got to calculate it in order for it to be reality. You got to normalize that cash profit. You find out what your cash profit is so you can know how your business is doing. Your tax profit's really just there so you can understand how much you've made from the IRS's eyes. So you have an idea of what you'll be paying taxes on at the end of the year. That's really the only use for the tax profit number. So we use the cash profit for that purpose, which is derived from a bunch of different metrics inside of the statement of cash flow. So we do utilize it because we also have things like the financing activities is the paying of the debt down and things like that. Even I get them confused. I don't remember the rules because the software does it for us all the time now. I think technically when you take out debt, it's an investing activity, but whenever you pay it back, it's a financing activity or something like that. Or maybe it's the assets go into the investing. It gets real complicated real fast. There's a real reason why we don't look at it again because we never use it. The only time I'll ever use it is when I'm helping someone understand what happened to their cash. And then you go in and if it's a well done set of financials, that those numbers will roll the right way. If there's a bunch of journal entries done to do the accounting every month, which is what a law firms do, the cash flow statement will not work because the journal entries will not be reflected appropriately inside of the statement of cash flow. So to answer the question again, the three things I look at is what is the actual cash profit? And then what is the delta of cash? And then what is that versus tax profit? Those are the things that I look at. They're not technically on the statement of cash flow, but that's what I look for when I'm using a statement of cash flow in the grand picture of things. I think I had a client actually asked me this one time of what's the standard that should be going into my investing activities inside of the cash flow, statement of cash flow. They were really studious. They'd heard about statement of cash flow and they'd read some type of book that had said that there was a really important number that nobody talks about or whatever it is. There is no standard for that. In a small service-based business, it's very much what you're doing, not versus what other people are doing. The ways and means that you get to those things, that isn't something that you can aggregate and then make an average of and have it be a meaningful number for anyone, I don't believe. Because there's so many different variables that go into it, such as what type of practice it is, what type of patients you have, how old is your practice, what's your production capabilities as a dentist. There's just so many different things that go into that, that it's a fool's errand to try and figure out is my investing activities on my statement of cash flow optimal comparatively to the other practices that are, out there? It doesn't exist. And help us please if there is a study out there that says that there's some averages that you should be looking at in dental practices, because I can only imagine what type of data they have. That's me in the statement of cash flow. So is there anything else that you wanted to add for that topic?
Back to that question that I got when I sat down and interviewed for a finance job. The
Hmm.
guys told me his favorite financial statement was the cash flow statement. And he was a
Hmm.
private equity investor. So basically, he wanted to know how much cash he could strip out of the business in owner's distributions every single month. So the cash
Hmm.
flow statement told him everything he needed to know. Did they make a profit or not? Add back depreciation, amortization, what were the loan paybacks? And then that's the cash I can then take out because that was the net change in cash over the point in time. Anyways, I always struggled with cash flow statement whenever I was coming up through the ranks in CPA land and in accounting land. Balance sheet income statement always made the most sense, but like I always got confused. What you're talking about, this financing versus investing. Like at the end of the day, the cash flow statement is trying to tell you, where does your cash go? Did it go up or down, and why? That's what you need to glean off your financial statement and the statement of cash flows.
Yep, absolutely. It's there. You just got to know how to read it. I tell Dennis to not spend a lot of time on that because context is so important. And if you don't fully understand the full set of financials and your industry specifically, you really just can't read a book to tell you how to read a statement of cash flow. It's not going to bear fruit. So to me, just hopefully you get good advice and people are painting a picture for you rather than you having to know all the ins and outs of the different elements of financial analysis. Those are the financial statements. And we've touched over things, believe it or not, even though we've talked a lot about the financial statements, we've just touched over the things. There's a lot more nuance that goes into the creation of these things. It's almost an art in a way of the start to finish creation of them and setting them up in a way in which it can be analyzed appropriately. And that was something that I struggled with really heavily on when we started our firm was I wanted to teach everyone how to read their financials. That was my goal in life because I was like, man, I'm going to teach people. They're going to be putting people at Goldman Sachs out of to shame because they're going to be able to know how to read the financials. And I quickly realized there's no reason to do that. Just tell them what they need, show them what they need. And so what we do in our firm is we definitely take those financials and we paint a tapestry of the important numbers. A good set of financials can be 6 to 7 pages long of data per period. And you do that over the course of a year. You've got 100 some odd pages of data. What we do for our clients every month is we set up all that information to a single page report that lets people understand really well the answer to 4 questions, which is how profitable are we? How well did we spend our money? How much cash did we make? And where did that cash go to? That's our goals with our financial analysis to give to our clients every month. And then we help people if they don't understand what the numbers say, then we teach them. We tell them how to read it and show them what happens. And then if they have any questions about their results, they ask us and we can give them our input from viewing that over 250 times a month. That's the way that we approach this challenge and approach the problem that there's not a whole lot of education out there on the financial statements. I'm torn on this one at this point because my thinking has evolved so much over the past 10 years. Would you spend time if you were a dentist going and taking like a course, like a 3-hour college course about how to analyze financial statements?
I wouldn't. I don't think it'd be a good use of your time. I think that if you got a good CPA or a good accountant that can help you understand your financial statements, then you can see what's going on month to month and tell you
Yeah.
everything. I think a 3-hour course, because it's not going to be relevant, right? Like the same metrics they're going to teach in that, they're going to talk about some of these higher level concepts like the debt to income ratio or the assets to liabilities or the current ratio. They're going to talk about a couple of those things. They're not going to say, here's what your supplies and labs need to be each month. They're not going to say, this is the typical in your industry, how much your overhead should be. Like if we're a construction business, we got more going on materials than you do in a dental firm.
And then there's also the different, the cost of completion method, or what's the other one? There's another construction one. I can't remember off the top of my head.
You really want to learn this at a high level, go figure out your favorite publicly traded corporation. Go figure out when their earnings call is. Look at their financial statements and listen to the executives talk about what's going on inside of those businesses. I think that would be a lot better use of your time. If you really love
Yeah.
Apple computers, figure out when Apple's earnings call is and go sit on their earnings call or listen to a replay of it and have them walk you through their financial statements. You get a lot more out of that because it's a business that you know and understand, or any of these publicly traded companies that are in the dental space. They'll talk to you about what's going on in the industry. Like those would be a lot better use of your time than taking a college class.
I agree. And the other thing that's really important is that the financial statements, they tell you what happened from a financial perspective. They don't tell you everything about your business. Like I told you at the beginning of the conversation that there's people out there that think that the financials have everything in there and they don't. Like I said, they don't show you a measure of capacity. They don't show you new patient inflows. They don't show you your production per day. They don't show you your open chair time. They don't show you how many patients are coming in to being rescheduled for your hygiene every month or every day. Those are important numbers to know if you're a practice owner, but they're not on your financials, and no amount of financial analysis is going to give you any of those numbers unless you bridge the gap between practice management and financial numbers. And what we tell people is that we are CPAs. And I know there's a lot of blurring of the lines of what CPAs do and don't do. But for us, we're CPAs. We handle financial analysis and we help you with financial analysis. Practice management analysis should be done by practice management consultants. And we are not practice management consultants. I know that there's a lot of blurring of the lines in the dental industry for what is a practice management consultant or not. And yeah, we know a lot about the numbers, but I don't know your hygienist. I don't know your office manager. I don't know your management style. I don't know what type of patients you have every day. I don't know how you like to turn patients over. I don't know how you like to have your tools set up, how efficient that makes your assistant. I'm not going to tell you how to do those things. I've never been a dentist before. I can tell you how to be a leader and things like that, but I'm not going to be able to give you that practice management information. And so to me, in terms of the best financial advice I can give someone is to pay a practice management consultant for that time that you're spending. Because if you're paying a CPA $200, $300, $400, $500 an hour for this advice, and if you have a CPA doing this for you, more than likely all they're going to find is problems. Probably not going to have any solutions. Probably just problems they're going to find. So rather than paying somewhere between $200 and $500 an hour for someone to find problems, pay a practice management consultant between $100 and $200 an hour to find the problems and give you the solutions. Much better use for your money, so to speak. Financial numbers can help you look for areas of focus, but they're not going to be giving you hard, cold facts that this is optimal performance. That's not how financials work, unfortunately. That's a big misconception too. I think there's a lot of people out there that get into this game because business is a game in a way, and they think that if I optimize the financials, I'm going to win this game. And it's not the financials. It's really the people that you got to optimize. It's really the performance, practice management. It's a different game. It's a different thing. And so I want to make sure that I'm putting that out there, that financial analysis does one thing. Practice analysis, practice management analysis does a whole nother thing. It's a whole nother ballgame. Any other closing thoughts you have, Joseph?
Well said, Jonathan. And ditto those things that you said. Financial statements can tell the story, but they don't tell the whole story. They can give you a glimpse of where you're at, where you've been. That's the other thing about financial statements is they're always going to be backwards looking. I had this conversation with one of our clients a couple of weeks ago. But inherently, they are talking about what happened in the past. It doesn't tell you what's going on in your practice today, what's happening, what's on the schedule for next week, right? Those are not going to come out of your financials. They're always going to be backwards looking. So the challenge is to marry the two, right? Come up with what your goals are, figure out what you did in the past, then figure out what your future needs to look like to get to the place you want to get to. And I think that's where the beauty is.
Yep, exactly. I agree. So anyway, it's been a fun set of episodes. Hopefully you've gotten a lot of value out of this, listeners. We talk about this too much already to our loved ones and they don't want to hear about it. So we appreciate you listening in. Hope you've had fun and we will see you next time. Thanks for listening to the Tooth and Coin podcast. If you enjoyed the show, we'd really appreciate it if you could leave us a 5-star review as well as a written review. Your feedback not only helps us improve, but also helps other dental professionals find our podcast and benefit from the financial insights that we share. So thanks for your support, and we'll catch you in the next episode where we'll continue to explore the business side of dentistry.